is Aida Naswa, and I will be presenting on definition, types of debenture, and characteristics. Definition of debenture. Debenture is an instrument used by a lender, such as bank for example, when providing capital to companies and also individuals. It enables the lender to secure loan repayment against the borrower asset even if they default on the payment. So usually, debenture is used to raise large amount of funds. So how do debenture work? Put simply, the borrower issue a debenture via an agreement called an indenture. Depending on the country of issue, this agreement outlines details such as the amount of the loan, its convertibility, interest rate, and maturity date. Then, the investor lend the fund to the borrower and expect repayment at the agreed interest rate. There are two types of debenture. The first one is fixed charge. A fixed charge is normally taken out against a tangible asset such as property. It enables the lender to take ownership of the borrower asset and sell them off in the event of a payment default. So with a fixed charge, the borrower would not be able to sell the asset without the lender consent. The second one is floating charge. So usually, floating charge attached to assets such as share, raw material, and intellectual property. That implies that the asset may change over time and the borrower can sell them without the lender's intervention. However, floating charge may become fixed if the borrower defaults. And when a company fails to make an interest or capital payment, the debenture holder can apply to the courts to convert the floating charge to fixed charge. Characteristic of debenture. There are 5 characteristics of debenture. The first one is holder. The person who holds the debenture, we call them as debenture holder. The second one is ownership. So debenture holder is a person who provides loan to a company and cannot take part in the company's management. The third one is return. Debenture holder are paid interest and it is not affected by any profit or loss in the company. Next, priority of claim. Debenture will get priority in case of company unable to pay its obligation. And the last one is interest. So they have a fixed redemption date and carry a fixed rate of interest so that the borrower has non-debt servicing commitment.
Next, passing up to me. My name is Dania Suraya and I will be presenting for risk and return for debenture. There are several debenture risks that might happen to the investor. The first one is debenture have the risk that coupon payments or capital repayment may not be made, but stockholders still have the security in the respect of the secured asset. The second one is interest rate risk. Interest rate risk might happen when the market interest rate is rising. If that happens, the value of bond or other fixed income investment will decline eventually. The third one is default risk. Default risk will happen if the company is struggling financially due to macroeconomic factors. This is may be caused by the increase in unemployment rate and inflation. Debenture holder would be mostly repaid before common stock shareholders in the event of bankruptcy. And the last one is inflationary risk. Inflationary risk might happen if the coupon paid cannot keep up with the rate of inflation of going up and going down. Despite the risk of debenture, investor will also get the return where the total return on debenture will reflect all of these risks that had been listed down above. A debenture pays a regular interest rate or coupon rate return to investor. Convertible debenture can be converted to equity shares after a specified period, making them more appealing to investor. This is because the investor will get a lower rate of interest after the conversion are made. However, in the event of corporation bankruptcy, the debenture is paid before common stock shareholders happens.
And lastly, my name is Ain Zuhra and I will be presenting about debentures marketability. Regarding marketability, debentures have a bad marketability. What and why? Firstly, it is not readily marketable. Each company has a certain borrowing capacity that they have to work with. Therefore, if that company has a high gearing ratio, debentures might not be easily available to them. Secondly, many people are hesitant to invest huge sums of money. As we know, debentures are used to raise a large amount of funds. If you want to get a huge amount, you need to invest huge amount. Moreover, there is no flexibility in their obligation to make interest payments since debentures interest rates are fixed. That's why some firms are not able to do that. Thirdly, high risk. In the debt ranking, debentures rank the first, meaning the most risky and need to be prioritized first. That's why their volumes traded are lower compared to government bonds. Moreover, debentures are not backed by any kind of collateral, which is something as a security for repayment. And lastly, yes, debentures did have a bad marketability. However, their marketability is highest just after a new issue. So that's the end of debentures marketability.